Hey investor friends, I'm Michelle Markey, and today I'm going to talk about the question of how much cash should we be holding on to right now in this current market environment. And if you tend to be more bullish right now, you tend to have less cash on hand, whereas if you're feeling a little bit more bearish, you might have more cash on hand. And I'll look at a couple of my favorite investors as to what some of their current cash positions might look like and what they seem to be doing right now in current market conditions. And also I'll share a little bit about how I approach my allocation with cash. And no matter how much any given individual, fund, or company might have in cash right now, it will be a different answer for everyone because everyone has different needs and goals, and we ultimately need to decide what's right for us in our situation. And I think it's helpful to look at how some famous investors like Warren Buffett and Mohnish Pabrai approach this and to see if I'd like to emulate them or just keep it in mind as a goal to maybe strive toward someday. I'd like to ask you, how are you allocating your cash in this current market environment? Please leave a comment below, and I'd love if you could also please like and subscribe because it greatly helps out with the YouTube algorithm and because I'm here to help you and myself become the best investors we can be. Thanks. Aside from doing some stock buybacks of Berkshire Hathaway, it seems like Warren Buffett hasn't been wanting to spend too much of his giant cash pile lately. And I remember back in 2020, the cash pile of Berkshire Hathaway being around $130 billion, and that's only gone up. According to a June 2021 Insider article, that seems to now be around $141 billion, which reflects 16% of the total $884 billion of assets that Berkshire Hathaway has. And this figure seems to be aligned with what Buffett said during the May 2021 annual Berkshire Hathaway meeting, in which he said in a response to a question that Berkshire likes to hold at least 15% of the total value of their business. And it looks like that seems to be pretty close to what that Insider article is also suggesting, that he's holding 16% in cash right now. And that also Buffett said during that same annual meeting that he would never let Berkshire's cash assets go below $20 billion. And that's a lot to have to go. That's only 14% of what his total current cash pile looks like. And also, it looks like from another article going back to 2017 that Berkshire has just been accumulating a bunch of cash to hold on to as the market has been getting more and more expensive throughout the last decade or so. And we can see that Berkshire had around $40 billion in 2013, and over the last 8 years that's gone up by another $100 billion. So it shows that Buffett isn't very enthusiastic about buying that much right now, as well as I've heard that Seth Klarman is willing to be in cash for years, and he's willing to underperform the S&P 500 or the stock market in general for years until he makes it up in multitudes. And we can see in this same article that he was trailing the S&P 500 for about 7 years in the 90s until he emerged to overcome and be known as one of the good investors that we all know him to be today. One of my favorite guru investors, Mohnish Pabrai, has changed how he allocates his cash over the years. And this 2018 Forbes article asked him if he still allocates cash in Berkshire Hathaway shares, to which Mohnish Pabrai said that he used to do that, but he realized that was a bit of a mistake because if there was a market correction, Berkshire Hathaway shares would go down in price, and if he needed the cash to buy something else, then he'd be sort of locking in a loss. So he decided that it's better to just leave cash as cash so that you have complete freedom and optionality to put it work when opportunities show up. And I feel like this is very helpful to keep in mind as to the power of having cash. And when I read about this Mohnish Pabrai approach to having cash available, it made me think of the idiom catch as catch can that I wanted to rephrase as cash as cash can, because it also makes me think of how Mohnish said that in many different ways cash gives you options and it offers wonderful downside protection and upside optionality. So in a similar way, in which even though I didn't know that this phrase came from wrestling, in which all moves would be permitted even though they normally wouldn't be, nowadays this adjective kind of means using whatever materials are available. And I kind of feel that way about cash, in that it's pretty versatile and it's the most practical option in which we can deploy capital in order to invest in the right opportunities. And that's why I'm just thinking of this random idiom to have a fond way of thinking about cash in a good way and not in a negative way when people like to say cash is trash. And I know that Mohnish Pabrai is a huge disciple of the way Warren Buffett invests, and he likes trying to compound his cash at 26% per year in investments he makes. And I know that he loves the number 26% so much that he even supposedly put it on his California license plate of writing in a cryptic way, compound and 26. So it's kind of funny that Mohnish feels so strongly about compounding money at 26% because it means that it leads to doubling your money in only 3 years. And I'll talk a little bit more about what that means. To explain how doubling your money in only 3 years can work at 26%, imagine you start out with $100,000 and you multiply that in the first year by 26%. That'll get you to $126,000, and then you multiply that amount by another 26%, and you end up at almost $159,000 in year 2. And then by year 3, by multiplying that amount by another 26%, you reach $200,000 in year 3. So that's exactly double what you had in year 0 at the 100K starting point. And this all assumes that someone's able to do the 26% every year consistently, which is not necessarily reflecting real life. It can happen, and that's a goal that a lot of great investors strive for and often can reach and surpass sometimes. So it's a pretty huge deal to be able to achieve 26%. And in a way, it's sort of like trying to achieve a marathon, and instead of maybe giving out those car stickers where you have the 26.2 in an oval shaped decal, maybe Mohnish should be giving out decal stickers of 26% to show how many people think this way and want to emulate how he and Buffett invest. And then you might be wondering, what's a good way to allocate one's cash if one wants to achieve compounded annual rates of return of 26% or more? And Mohnish Pabrai actually has an answer to this. And I came across a couple of blog posts where some people posted about his framework, and one of them talks a little bit differently than the other in terms of the specific percentages and how much baggers we should aim for. But all in all, think of these allocation strategies as trying to achieve your 26% or more in only 2 to 3 years, depending on the investment type. So it generally goes like this. In the one blog post that I'm going to use, he says to have 75% of his portfolio in an investment that you think can double in 3 years. And so that's a 2-bagger or 2x. And then to have the remaining 25% split across 3 to 5x investments. And that means that 10% would go into a 3x or 3-bagger investment, and then another 10% would go into a 4x or 4-bagger investment. And finally, that you would put 5% in what you might think is a 5-bagger or 5x opportunity or better. And I think that this is a very interesting way to think about how Mohnish Pabrai likes to allocate his cash and how he's trying to mitigate any risks by allocating his portfolio in things that he believes has a reasonable chance of reaching 2x in 3 years, and that's why he has the majority of his portfolio in something like that, whereas investments that he thinks might not reach 3 to 5x in only 3 years, he allocates a little bit less towards those types of positions because maybe some of those investments may or may not really reach that type of amazing return rate in a short amount of time, considering that 3 years is really not that long of a time to be invested in something. So with all that, I wanted to try to figure out how much Mohnish is managing right now and how much he might be allocating to cash. And I know some of this is kind of difficult to figure out because I know he has investments in other places like in India that are not shown in his 13F filing. So it's kind of difficult to really know how much Mohnish is sitting in cash and how much is invested in securities that we as everyday retail investors can know about. But I came across a few posts that maybe give me a little bit of clues. and they're a little bit confusing, and I'm trying to get to the bottom of it. So if you know the answer, I'd love to hear from you in the comments. And what I found so far was in 2018, supposedly Mohnish was managing around $800 million, and of that 10% was in cash at that time in 2018. And then looking at his profile in Guru Focus, that he currently has $262 million in securities, and I know that's from his most recent 13F filing from Q1 2021. And that profile also says that he's got over $400 million in assets under management. And then another article from Seeking Alpha from March 2021 talks about how Mohnish has around $469 million in assets under management. So who knows what exact figures he's really managing right now, but I'm also gonna check one more example to see if I can try to figure it out. And then I came across the Whale Wisdom page for Dalal Street LLC, which is a hedge fund that contains the Pabrai investment funds 2, 3, and 4 as far as I can tell. And in this, I noticed that it says the discretionary assets under management amount to $637.6 million, of which $180.4 million is attributed to non-US clients. So seeing that on the form ADV was helpful to know, and that makes me think, is the amount remaining that's already invested in US securities or available to be invested in securities 457 million if we subtract the 180 from the 637 million? And this number is also kind of similar to that March Seeking Alpha post that talked about how he had $469 million in assets under management. So it makes me wonder if that 457 million is pretty close, and if so, could this mean that 262 million of that is invested in certain securities we can buy in US stock exchanges? And if so, does that mean that maybe the amount that's remaining is really 30% in cash that Pabrai might be sitting on? I'm not really sure, so I'd love to hear if anyone has done better research into this, and to please let me know if you figured out how much cash Pabrai might be sitting on. Based on now knowing these puzzle pieces of how I know Mohnish Pabrai likes to allocate his cash, it makes me wonder if his recent stake in Alibaba of $38.3 million makes him believe that it could be a 3 to 5 bagger in the next 3 years, which would be pretty impressive. So knowing what I know, if let's say I take that $38.3 million and divide that out of his total assets under management that I know of, that is $637.6 million, that's exactly 6%, which would put his Alibaba stake closer to a 5x that he's thinking this might become, or a 5 bagger in maybe 2 to 3 years. And I compare that to maybe that $38 million, if I divide that out of 469 million based on that Seeking Alpha article, that's around 8.1%. So that's closer to maybe being somewhere in the 3 to 4 bagger range. And also in a similar way, if I divide that 38.3 million into 262 million, as we've seen in the 13F filing, that would put that position at 14.6%, which is clearly within the 3 to 4 bagger range. So I find that kind of fascinating to kind of guess at how Mohnish might be thinking about his position in Baba and where it could go from here. Assuming Mohnish Pabrai and Warren Buffett are trying to have only 10 to 15% in cash, I would love to also be there, where I would love to have 85 to 90% of my cash invested in my favorite company's stocks, and then I'd be a happy camper trying to compound that at 26%. And by not being in that much equities right now, I'm actually having big opportunity costs and say a cash allocation right now of 40% in cash and 60% invested. How much more I would need to be able to outperform in order to achieve something like 26% if I had been 100% invested, or 15% if I had been 100% invested, and how much the math changes if I'm only 60% of that original cash amount invested. So it's a huge thing to be sitting in cash, and it almost makes you think that I'm a fool on the way up, with the markets just going up and up by sitting in as much cash as I am. But I'd rather be sitting in cash so that I can deploy that when I feel like the right opportunities come along for me and I can buy my favorite companies on sale someday. And also I just want to share, in recent history, back in 2017, I was 80% invested in equities in the form of mostly index funds and mutual funds and robo-advisors. And that means I was only 20% in cash, which to me was a pretty good amount at the time to have as a safety net. And eventually I would like to get to a point where I would only have 10% as a safety net as opposed to the 40% that I'm sitting at right now. And more recently, I'd actually had been over 50% in cash. And so I did some moves recently so that I'm no longer in the majority of having just cash, but I'm still a little bit behind where I'd like to be. I'd like to try to perform better in my investments, but I'm waiting for the right fat pitch, to use a baseball analogy that Warren Buffett has shared. So even though we had that flash crash in March 2020 where the S&P 500 dropped by about 34%, and since its last high back in February 2020 has gone up by another 25% as of June 2021, I don't feel very confident in buying into this market because I feel like it's pretty overpriced, and I don't feel like most of the equities that I'd like to buy are on sale right now. But it leaves me no choice but to sit on my big cash pile, and I feel pretty secure because there are a few investors that I respect and admire who are also sitting in around 30 to 40% of cash. So I feel pretty good about that, at least, that I'm not the only one who's trying to hoard some cash right now. And that helps me better sleep at night, knowing that I have some ammunition to be able to deploy in the markets when it's my time to invest. Back in 2017, I had an awakening as an investor when I came across the Invested podcast by Danielle Town and Phil Town. So that made me want to become an investor like Warren Buffett. So I realized shortly thereafter that I couldn't stay invested in a bunch of index, mutual funds, and robo-advisor positions, because that might lead me to only achieving the stock market's average rate of return of somewhere around 7 to 10% per year. And that's okay for most people, but I want to try to be better than average if I can. So I'm trying to push myself to try to achieve rates of return of maybe 15 to 26% per year. And I haven't quite made it yet, but it's also been at a point in the markets where a lot of things are overpriced. So to me, I'm just trying to bide my time. And I also try to remember this key principle that Phil Town advocates for, which is rule number 1 that comes from Warren Buffett, in which he said, rule number 1, don't lose money, and rule number 2, don't forget rule number 1. So I try to keep this in mind and reassure myself that it's okay to be sort of missing out on the market's gains right now for an eventual rewarding experience of hopefully buying my favorite companies when they're on sale. And I hope I'll be able to do the right thing like Buffett and Pabrai have done all these years, and to live up to the hopes and dreams I have for achieving higher than average rates of return. And other things I do to try to improve on my cash position and my odds of outperforming in the long run includes how I max out my contributions to my Roth 401k nowadays, and I get the after-tax match as well. So I'm actually treating that as a big piggy bank to save Roth money, so that eventually I'll roll that over into a Roth IRA and be able to generate tax-free returns on that, because I'm not the biggest fan of just investing in mutual funds, because I know some of them can take higher expense ratios, and right now I think as things are overpriced, I don't really want to be too much invested. So I'm just treating that as a big cash savings account right now, and I don't expect that to generate a lot in interest. And I also max out my contributions to my Roth IRA and my health savings account. So to me, that's a lot where I'm trying to just put a bunch of cash away for the day when it's my turn to invest. All in all, I feel pretty good about my capital allocation decisions right now, and eventually I'll look forward to trying to only be in 10% cash as my sort of safety net or emergency fund, and then 90% in equities, and that'll be good enough for me. And I'm determined not to let FOMO get to me and just do my own thing and keep my head down and keep studying and following my favorite guru investors. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to becoming the best investor you can be. Till next time.